Not all insurance companies are made the same. First of all, you're basically buying two businesses when you're buying the insurance company. You're buying the underwriting business of whether they can get more money in than they have to pay out in claims, and then you're buying the funds management business where they're investing their float. So as the first business goes, all the insurers are kind of different. IAG is a lot of car insurance, home insurance, that sort of thing. QBE obviously has a far more diversified insurance as far as global reach and products under which they insure, and Suncorp is probably more diversified still. So you have to really pick the business that you like in that sense. We still quite like QBE on valuation grounds and global spread. They've gone through the process of getting rid of all their sort of poorly performing assets. They've possibly gone into the shell a little bit too much, and they sort of said, oh, we're not going to get aggressive in our underwriting, but of course they have to underwrite something. It's not a completely risk-free business, so hopefully they get that balance right, but the market's not pricing in any growth. But then on the you can compare apples for apples on, if you like, the funds management side, and that then you have to analyse how the insurer is actually investing those funds. IAG and Suncorp have got more of an equity exposure. QBE's been increasing that in recent years, but it's still predominantly related to interest rates. So if interest rates go up 50 basis points, IAG's profit goes up by 7%, Suncorp's by 4%, QBE's by 13%. So QBE has got a lot of the turnaround of the insurance business is possible. A lot of upside in a rising interest rate environment. So I think that again, on a risk-return basis, QBE, if you have to have an insurer, is probably the pick of the bunch in my opinion. It's a cyclical business. So what happens is you have a lot of disasters. People are underinsured. Then premiums go up, and the volume comes in because a lot of people that weren't insured or underinsured, they start insuring. So the insurers actually make good money. And over time, if you have benign, say, weather patterns, or you have very few claims, the insurers start getting a bit more aggressive in their pricing, and they sort of squeeze the pricing a little bit, and the consumer starts to underinsure because they think, there hasn't been an accident in 20 years, whatever, so they stop insuring, and then of course the event happens again. So the pricing does tend to be cyclical, inversely related to the amount of claims. The IAG, if you look at their car insurance business, the best way to analyse that is you look at the weather patterns and the rainfall. There's obviously a hugely direct correlation between rain patterns and crashes. But it's not only crashes, it's hails, it's theft, it's all that other stuff that they insure on. That won't go away with autonomous cars. Obviously there will be far fewer crashes when it comes to autonomous vehicles, and the insurers will find a way of finding something else to insure. We had a company in recently trying to IPO, and they sell life insurance, but they brand it different things. They might call it mortgage insurance. Basically, so if you die, you can pay off your mortgage. It's life insurance, but it's just brand. They could call it private school insurance. So if you die, you get enough money to pay your kids' school fees. So the insurers are pretty clever at finding ways of repackaging risk and selling it under different sort of auspices.